In the world of Forex trading, not every participant is an active trader executing orders and analyzing charts constantly. Some people prefer to let their money be managed by experienced traders to benefit from their knowledge and expertise. This is where PAMM accounts, or Percentage Allocation Management Modules, come into play. This investment system allows individuals to invest indirectly by delegating the management of their capital to a professional trader while sharing the profits and losses generated. In this video, we'll explain what PAMM accounts are, how they work, and their benefits and risks. PAMM accounts act as a bridge between investors and professional traders. Here's how it works. A trader, also known as the account manager, opens a PAMM account on a trading platform that offers this service. Interested investors can then allocate a portion of their capital to this account. The manager uses the combined funds to trade in the Forex market, and the profits or losses are distributed among investors based on the percentage each contributed to the total fund. For example, imagine a trader opens a PAMM account with an initial capital of $1,000, and 3 investors contribute $2,000, $3,000, and $4,000, respectively. This creates a total fund of $10,000. If the trader generates a 10% return in a month, that's $1,000 in profit. The profit is distributed proportionally among all participants. The manager takes a pre-agreed percentage as a performance fee, and the remaining profit is shared among the investors based on their initial contributions. One of the biggest advantages of PAMM accounts is that they allow investors to access the Forex market without needing advanced technical knowledge. They don't have to analyze charts, track trends, or execute trades. Instead, they entrust their capital to an experienced trader who handles the entire process. Additionally, account managers typically have a verified track record of successful trading, which provides confidence to investors. However, like any investment, PAMM accounts come with risks. Even though the manager may be experienced, there's no guarantee of consistent profits. The Forex market is highly volatile and unpredictable, meaning losses are possible. It's also crucial to choose a manager with a reliable track record, and to carefully review the PAMM account's terms, including fees and withdrawal policies. Another key benefit of PAMM accounts is their transparency. Investors can monitor the trades executed by the manager and the results in real time. This allows them to evaluate whether the trader's performance aligns with their expectations. Moreover, most platforms offering PAMM accounts provide detailed, analytical tools for investors to make informed decisions. In conclusion, PAMM accounts are an excellent option for those who want to participate in the Forex market without trading directly. They provide the opportunity to earn profits by leveraging the skills of experienced traders. However, it's crucial to understand the associated risks and choose account managers carefully. If you decide to invest in a PAMM account, make sure to research, analyze the trader's track record, and diversify your investments to minimize risks. If you enjoyed this video, don't forget to subscribe to our channel for more Forex and investment content. Leave us a like if you found this information helpful. Share it with someone interested in learning about Forex, and let us know in the comments what topic or concept you'd like us to cover in future videos.